Let's get across the market open. Kyle Rodder joining us from capital.com. Kyle, welcome back. So we've seen global equities rally across the board. Investors very much buoyed by the prospect of a rate cut by the Fed next month. Plus, of course, we're going into Thanksgiving Day holiday as well.
Yeah, so markets will probably be thin in the next couple of days, but I mean, what we have seen this week is the markets pretty much go back to pricing in somewhere around an 85% implied probability of a December rate cut. And, you can't sort of blame investors for feeling a little bit whiplashed over the last fortnight or so because we've gone from, around that kind of 85% implied probability of a cut down to as low as the sort of mid 20s at the back end of last week. And, this week, mostly by virtue of some dovish Fed speak on Friday and then subsequently Monday, the market's pricing in once again that, on the balance of probabilities, there'll be a rate cut in December, despite the fact that we haven't had that much substantial data and that, we won't get that much substantial data until the next Fed decision. So really equities are rising high on that. We're seeing, volatility start to ratchet down just a little bit, especially in the bond market, which, the equity market seems to have sort of followed in quite a close inverse relationship recently. And, with the next kind of 48 hours, again, being fairly thin, something of a vacuum, there is the expectation that, sentiment can remain reasonably, well supported and that, notwithstanding pretty much from here, some hawkish Fed speak or something that would sort of upturn those expectations of a rate cut, a market that seems to want to sort of, drift higher from here.
Interesting also, given that buoyancy we're seeing with sentiment, investors appear to be looking past those stretched tech valuations at the moment. Tech back on the beat at the moment.
Yeah, certainly. Interestingly enough, what we have seen in terms of tech valuations in the last probably week in particular is that, by virtue of, first of all, the fact that we had a sort of 6 or 7% drawdown in the Nasdaq and, probably slightly larger in some of those Magnificent Seven names, albeit, relatively briefly, we do have Alphabet and Apple at record highs for their own reasons. But, again, by virtue of that little drawdown, but then also upgrades to guidance coming through from companies during the reporting period, the multiples for the S&P 500 have actually compressed slightly, and we've seen the forward price to earnings ratio on the S&P 500 come down to about 23, which was comparable to what we saw in the kind of dot-com bubble, as well as, and more pertinently, the kind of COVID everything bubble, down to about 21 and a half. So still, historically rich, kind of well above the 5 and 10 year averages or so, but certainly seeing a kind of a drop in price as well as a lift in earnings expectations to make valuations a little bit more attractive. Lo and behold, I think it should be said that I don't think much of this sell-off in the last couple of weeks was to do with kind of, tech valuations and AI overinvestment. There's a little bit of it there. It's still a pertinent issue, but it's one a little bit further down the line in terms of, what investors really have to grapple with. It's really been this kind of rate volatility, which, you could probably argue is actually quite a bullish thing for the market, because if it's, again, 90% rate volatility, we've still got, companies providing upbeat guidance, especially tech companies providing upbeat guidance for earnings in 2026. If we can keep that rate volatility to a minimum, maybe stocks can continue to push to record highs. We'll have to see. But again, nevertheless, we are seeing tech still fairly richly valued, but it has to be said a little less richly valued than before.
Kyle, turning to your part of the world where you are at the moment in the UK, see the FTSE 100 was up close to 1%. In fact, markets appreciating what they heard from the government in terms of the budget update, although perhaps the British people not so.
Well, yeah, the sort of scuttlebutt around the office was, some degree of either, frustration because they're going to be sort of slugged with a little bit more tax than they were expecting otherwise, or perhaps they'd slip into a tax bracket that they would otherwise thought that, they might have had some reprieve from in the next few years, or, that there might have been certain initiatives that they might have benefited from in terms of, a welfare perspective. But I mean, if you do look at the market response, there is clearly endorsement there that we didn't get the kind of trust bust that when it comes to these budget updates or budget announcements in the UK, there's always that kind of lingering fear and scars from the meltdown that we saw during the very brief Truss government a few years ago. But then also on top of that too, there was more fiscal headspace revealed in the budget. Some initiatives to improve fiscal settings in the UK. And while it does, only fairly marginal things to improve the long-term prospects of the UK economy, which is clearly in some state of stagnation, arguably a state of stagflation, on net, the budget was sort of treated as being kind of a positive thing. So as you noted, FTSE up by 1%, but we also had the pound moving up by about 0.5%, perhaps even a little bit more than that at different stages, and also gilt yields lowering too, sort of reflecting that lower risk premium. So overall, kind of a positive development, albeit in the grand scheme of things, only sort of a fairly marginal benefit to the overall economy.
And Kyle, locally here in Australia, look, focus very much on what the RBA is likely to do next, and those bets that it's going to sit pat for an extended period of time, reinforced yesterday with those inflation numbers.
Yeah, and that kind of concerning picture emerging now that inflation's reaccelerating and is well and truly potentially outside of that 2 to 3% target band. And we saw a bit of a rally in the Australian dollar by virtue of that. Also, the RBNZ sort of reflecting similar fears that after some fairly significant rate cuts, much steeper rate cuts, it has to be said, from the central bank, that inflation's just a little bit too stubborn and a little bit too much of a nuisance to be able to ease much further, and that subsequently markets are now pricing in that there's a very high chance this is the end of the rate cutting cycle, pertinently for the RBA. I mean, I think personally, there's one thing at the moment that market participants are perhaps underappreciating, and that's the upside risks to inflation next year, and that despite the fact that we had some of these doubts emerging in the markets about the Fed being able to cut in December, which was by design from the Fed, and probably because it itself is just a little bit concerned with where inflation could go in the year ahead, especially considering it's still above target and already above target. There are significant forces coming down the pipe that suggests that right across the globe, inflation, if not sort of extinguished entirely and sort of defeated, which it never really was in most parts of the world after the sort of the pandemic inflation surge, that we might be actually seeing the risk of some accelerating inflation going forward. Again, raising questions about monetary policy, suitable levels for monetary policy, and therefore stock market valuations. So a kind of microcosm in Australia for something that I think is going to be pertinent around the rest of the world, but certainly one that is a bit of a drag for our equity market, and one that's kind of going to keep a bit of a lid on risk appetite, while the inflation fight more or less continues.